Hello, everyone. Today is July 24th. Today, we're going to talk about the portfolio, just generally how it's doing. So yesterday, I made two videos talking about what I was working on. And actually, just on a side note, feeling much better today than I was yesterday. Yesterday, I think I might have sounded a bit tired. And so therefore, it was a little bit harder for me to stay on topic. But today, I'm feeling rested up, but just kind of yeah, I've been having a little bit of a tiring week. But that said, thank you so much for your patience if you did watch yesterday's videos. And today I'll be a little bit more cogent in my responses or in my in my talks. That said, so going back to the portfolio, as we talked about, I purchased 19,000 shares this Monday. I sold 190 covered calls. Effectively, that's $13 a premium per contract. So $13 times 190 contracts, roughly $2,500. But you have to take away the fact that I am pretty pretty leveraged in the sense that I'm borrowing about 70K, roughly 70K. The interest rate for this, if I remember correctly, is about 6.5%. So if we were to do the math, we could see that if you have 70K, 1, 2, 3 times 0.065 on a yearly basis, that's about $4,500. But if we were to divide that on a monthly basis, that's about $400. But given that I'm only going to borrow it for about 2 weeks, roughly about 2 weeks, then it's $200 taken away. So like I said, I'll be making $2,500 as long as it stays above 650 minus the $200 that I have to pay in interest. So then that's a roughly $2,300. Just to keep it simple, I'd like to say a little bit over 2K. So that said, I also explained yesterday that I had two choices that I was considering, either selling the $7 strike price or selling the $650 strike price. During times when the market goes down like it did today, these are times when, going for the very safe option does feel nice just because, otherwise, it can be that the downtrend continues. That's not something I would want. But let's say if the downtrend does continue, I'm protected and I get to get paid out the full premium up until $6.50. And once again, since the earnings date for SOFI is on Tuesday, right? I believe the 30th, pre-market on Tuesday. Yes, pre-market on Tuesday, which is less than a week away. What's really nice is I'll be able to capture most of that premium, most of that 2,500 by Tuesday. So actually, I could probably sell out early, maybe for a little bit over 2K after Tuesday, either Tuesday, Wednesday, around there. Because by that time, let's say SoFi is still about $7, then the contracts will be worth very little for 650, and I could buy it back for about a penny or two. That's something I might do. If not, I'll let it expire in the money. And I'll just get my shares called away, and then I'll just kind of repeat this, rinse and repeat. Now, another reason why, I think it's important to, or at least for myself, so this is not financial advice, for myself to kind of go for very safe bets is the following, is that, as you notice, the market's just been at all-time highs, and that kind of is not very, does not bring me peace in the sense that it is good that the market has been increasing, yeah. But at the same time, we have to recognize that the market doesn't always just go up, right? The market has corrections. The market right now is generally overpriced in the sense that overall the average PE, I think, is well above 25. And historically speaking, it tends to be around 20 to 25, 20 being on the lower range. So because of that, we're at a pretty well valued to overvalued price for a lot of the stocks out there. Not all individual stocks, like SoFi, I don't think it's overvalued. I think it's undervalued. I think another one that might be undervalued, in my opinion, is Starbucks, potentially PayPal as well. So there's a few stocks here and there that are undervalued, but for the large part, a lot of them are overvalued. You look at companies like Tesla, you look at a lot of the overvalued or well valued. So like Tesla, the AI companies, the companies like some of the Bitcoin miners. If we look at like the Magnificent Seven, so like Google, Netflix, and so forth, all of those tend to be well valued to overvalued. And that's why it doesn't really shock me if they were to increase in price. So going back to this, look how high we are. In October, we did have a correction, but since then we've just been going up nonstop. We're near all-time highs, which is like 560. So it's because of that, and because we haven't had like a significant correction of about, let's say, like 20-30%, you got to be wary about that. You got to be wary until you either pick a stock that's undervalued, or you wait until the market gets kind of back to less frothy values. So that's kind of how I heard it. Going on to that, I did want to talk about a question that I received. So this question that I received, I want to kind of address it. So what is your thought on trading options on NVIDIA? So this stock, it's like a leverage position. The premium is high. Okay, so we're selling covered calls on NVIDIA, and if we sell them when they have high premiums, then we're able to capitalize and kind of get a better ROI. Generally speaking, it tracks NVIDIA and it doubles the percent of NVIDIA. So essentially, there are certain stocks which are I don't know if they're ETFs, but they're ways to position yourself 2x, 3x, several x, whether it's a call, whether it's a long position or a short position of an existing stock. So in this case, it follows NVIDIA, but it 2x's whatever the profit would be, or it could 3x, 4x, 5x. So it just depends on what it specifies in the prospectus. Right? So the actual stock will mention what leverage it has on it. So it says, I currently have a sell call, so selling covered calls because the premium is high, and it's cheaper to own than the ETF, or it's easier to own the ETF than it is NVIDIA, or it's cheaper to own it, which makes sense. So we want to be able to leverage ourselves in terms of, we want to be able to be within NVIDIA without having to pay. Right now it's like around 120. So then 120 times 100, that's roughly 12K for a single covered call. Pretty expensive, right? I also believe NVIDIA will keep growing over the years, so I don't mind owning this ETF because the returns will be done. Yes, so that's good from a long-term perspective if you're interested in owning it. So if you have so once again, this is not financial advice, but this is just my take on it. So if a person is interested in owning something for the long term, then that's perfectly reasonable to own it. One thing I would caution about, I would actually say two things I would caution, just in general for myself if I was in this position. First, I want to talk about NVIDIA. NVIDIA. There we go. Am I spelling it wrong? NVIDIA. Oh, yeah, I spelled that wrong. Sorry. So if we look at NVIDIA, we could see that I mentioned that a lot of companies are well valued. So it looked like it had a bit of a down day today, and which is okay. But if we look at its P's or its earnings, in general, its earnings has been increasing significantly. The CEO right now, he's walking on water just with how well he's doing. So he's been managing it very well. I don't know how he's getting all these record profits after profit after profit, but he's doing an amazing job. That said, we could take a look at the PE. Let's see. I want to say, there we go. Our price to earnings right now is around 71. We take a look at historically. So then history, price, PE, NVIDIA. There we go. I like to look at micro trends, and it shows me if a company is relatively well priced or underpriced for how it's been doing. I try not to look at it all time just because that considers its scope like way back when it either IPO'd or became, went through the stock. It's essentially whenever it was posted to the New York Stock Exchange. But let's take a look at it. So right now, as we saw, it's roughly 66 PE. If we take a look at it from the past, during that boom this year or last year, it was quite overvalued, at least just from a PE perspective. Right now, it's still sitting a little higher than normal. So if you notice, it likes to sit around, just from 2022, sit around a little under 60. So it's still, maybe if it was in that 50 range, it would be a little bit more comfortable. So if we were talking about the 50 range, right now it's 66. So if I have 100, how much is it? $116. I divide it by 66. And then we multiply it by, let's call it 50. if it was around the $90 range, $100 range, that would be more in line with what it's been doing previously, kind of like on the smaller end. Not to say that it's bad that its current valuation. It's just my thesis tends to be solid. But you buy a solid company. This is a solid company. This has been doing incredibly well, but at a undervalued price. And right now, I think it's a little bit overvalued, a little bit. And so as you can see, like there are some estimates that are placed on here from research reports, so like Morningstar. You can see they value it at 105, kind of in line with what I was mentioning. That doesn't mean it's true. They could be completely off, but this is just something to consider. And the other thing is that we have to be careful with the recent growth of companies when a company just kind of skyrockets. The reason is that you have to look at its market capitalization. You have to see, is it expected that this trend can continue? So if I go to NVIDIA market cap history, there we go. And we go back to macro trends. I want to show you something that can maybe blow your mind a little bit. So if we take a look at just the past 2 years, this company went from a little bit under $1 trillion. Here's $1 trillion up to its high of $3 trillion. I remember when that happened, I was thinking that's incredible, but it was under $1 trillion, right? So here we go back to the beginning. Let's see where. So we go to the beginning of the year. Yeah, it was roughly at $1 trillion, and it went to $3 trillion. Do you realize how big that is? If we look at the top market capitalization companies, we can see the following. NVIDIA went all the way from 1 trillion down to let's call it around under Meta, right? Where essentially where Meta was, and then it just hopped over all the way to nearly being essentially at one point it was the highest market cap company, which means that just from like a financial perspective, it was 3 times, at one point it was 3 times the value of Meta. So all of Meta 3 times. Think about it from another perspective. It's let's say Tesla. So Tesla 700 billion. So times to get that to a little bit over 3 billion. What is that? So like four times. It was 4 times the valuation of all of Tesla. It went from being a little over 1 times Tesla to being 4 times Tesla. So just think of how big of a growth that is. That's not to say that it's not deserved in the sense that they did just increase their earnings significantly. It's just I really don't know how they did it, but will they be able to continue that trend? And as you can notice, their next projected earnings, it doesn't look like it's still on that growth trajectory. It could be, but it could, if it were to go under estimates, it could have a rude awakening in terms of a significant drop. And if it does go to a significant drop, remember, stocks always fluctuate between its fair value. So it goes above its fair value and then below its fair value. I'd rather pick up a stock when it's below its fair value. So that's one caution I would say about NVIDIA. Once again, it's an amazing company, but as far as its price, for me, that's why I'm not looking into getting into it. On the other hand, SOFI is nowhere near as great as like NVIDIA, but that SOFI I think is undervalued. So with respect to that, it meets both of my criteria, and that's why I'm currently in a position in SOFI. If NVIDIA was undervalued right now, if NVIDIA was like $80, I would be buying it up left and right, selling covered calls on it, and using that. So that's one perspective I have with respect to NVIDIA. The other thing I wanted to address was NVIDIA, which is these leveraged ETFs. For the leveraged ETFs, I kind of am worried about them. The reason being is that there's other ways to leverage yourself directly with the stock, as opposed to ETF instruments that will leverage for you. So yeah, I just kind of tend not to like them because while it's supposed to be 2x the position, sometimes it may not reflect that just due to the expense fees. So notice whenever you have an ETF, there is an expense ratio. So in this case, it's 1.57%. That might not sound like a lot, But there's something like take a look at statistics, like let's say your 401k portfolio. If they were to charge you about 2%, just generally speaking, if you put your money in S&P and you get charged 2% per year, I think it would decrease your, I forget the numbers, we can run it in a different video, but it would decrease your earnings by the time you retire by about, I think, half. That's like a half reduction. So if you would have had $1 million, now you have $500,000. It doesn't sound like a lot, but these percentages do add up. And so that's something I wouldn't want to get into. Now, as far as the premium, we could take a look at the premiums. Let's see. So right now it's roughly at $59. So for me, let's say I wanted to sell this. So if you were to sell this on Friday, you get about $1, let's say $1.70. That's pretty good, actually. That's pretty good. So minus the 20 cents, so $1.50 out of the 59. So 1.5 divided by the 59 that you would invest in. So roughly 2.5% from now until Friday. That's pretty good, actually. That's pretty good. But at the same time, its movement is pretty wild, right? Let's do it until earnings. So if we go into NVIDIA, I think NVIDIA earnings are. Let's go to the NVIDIA earnings, and then afterwards we'll see that on NVIDIA. So its earnings are going to be on August 28th. So let's go back to NVIDIA. So if I try to trade options on NVIDIA before the 28th, which would be the 30th, let's look at the difference between the two. So if I go 23rd, which is before earnings, and let's say I sell it out of the money right here at 59, it's $6 roughly, right? Let's go to 1 week after, $59. It's 9, so it's a 50% increase for that 1 week. So that's why there's kind of a big move. Myself, what I would probably do, like I said, I don't think I would go into this just because, once again, NVIDIA I think is a little bit well valued. And then the other thing is that I wouldn't want to leverage myself in this way. But let's say if I did, then I would probably do the 23rd position, sell a call, probably at, just to see what the price would look like. So you could see you're still making $7 here, you're still making $6 here. I would probably put around like maybe $57, so just to cover yourself if it were to drop. Let's do this 56. Let's see if this is realistic. It's bid ask 470, 670, 540. Yeah, so this is still, there's quite a bit of spread here. So then let's look at 57. No, it's still a bit of spread. 58. Yeah, so these just have a pretty significant spread. So that's where it's kind of difficult. But anyways, for myself, I would probably do once again a little bit in the money. You still get around $6 profit for the 23rd, and then if NVIDIA held its price, then you'll be able to, or like once again, this is not financial advice, but I would be able to then sell off the next week into earnings if I think it's going to have good earnings. If I think there's the potential for NVIDIA to kind of miss, which right now it hasn't been doing that. It's been doing incredibly well. But if it does miss, it's gonna have a, generally speaking, it's gonna have a huge overreaction by Wall Street and could be down 10%, 20%. So that's where it could hurt you quite a bit. So in this case, I wouldn't even consider doing this one. I would probably just do the 23rd if I think it's still going to be stable until then. And then I probably would just get out of it until after earnings to see if they're still kind of walking on water as far as their earnings, or if they had a massive reduction and still in it for the long term, then I would just buy it at that lower price after. So I would just kind of stay out of it, and that's part of the market that I think is important to develop. Being able to stay out of it until it's the right price. It's kind of like fishing, or like I think like baseball. I don't really play it, but you kind of wait for your pitch, and so you wait until, yeah, it's a good company, but wait for to get the right pitch, wait for it to be the right price. Now, I hope that makes sense. But, and also as far as leverage, I want to just allude to this. There's this idea of a poor man's covered call, where you could leverage yourself while instead of having to have $100 or 100 shares worth of a position, So in this case, it's $115, which would be times 100, which is 11,500. You might not want to put 11,500 in here and then sell calls. Another way to kind of go about it is you can buy leaps and then sell poor man covered calls. That's kind of like another strategy that um, I would consider for myself, right? Not financial advice. You generally want to buy them far out. So like for example, January 2026, give yourself or give myself wiggle room. I would go in very, very deep in the money to the call. I'm talking about like almost half the price of the stock, let's say $60, just to make math simple. $60, it costs, let's look at the bid ask. Yeah, 62, 68. Okay. So it costs, let's call it $65. So you'll notice $60 plus 65, what is that? That's 125. So if you buy this, you're essentially have $10 of extrinsic value. You're paying $1,000. $10 is times 100 is 1,000. So you're paying $1,000 to be able to pay for 540 days worth of time on this stock. But instead of me having to pony up 11,500, I only have to pony up $6,500. I am paying $1,000 for my time, but I have intrinsic value here because at $50 to 115, what is that? $55. So 55 out of the $65 is intrinsic. If I were to buy this contract and then execute it immediately, right, I get to that's value I have right now. It's only $1,000 that I would lose, and that's spread over 540 days. But as we know, because of theta decay, it tends to be very slow up until we reach the 45-day mark, and then it starts to significantly increase. So you'll notice out of that $1,000, you're only losing $2 a day. Right now, it's every day you're losing $2. That's not bad. That's really not bad because what if it has a significant move? Like let's say you're interested in it. Look at its delta. So if it goes up $1, you get $90. But for every day, you lose $2. Right. That said, also if it goes down $1, you lose $90. Right. So not to frame everything in the best light, you have to know the risk. But that said, like if you wanted to leverage yourself, right, you could. There's ways to directly get on this. By buying a leap if you're going for the long run and just you could hold it like this. And if you want to lower your cost basis, or myself, like once again, it's not financial advice, but let's say I want to sell a call for January because I don't want to have to pay the 6,500. So I'll wait until let's call it January. And the trick is, remember, you break even at 125. We mentioned $60 plus the 65 is 125 times 100. It's the 125 is where you would break even if you bought that call. So then I would sell the 125, and notice that they'll give me $15. So essentially, I would break even. So I would buy the leap for January 2026, and then this is a hypothetical example. I would buy the leap. Let me write this down so that it's a little bit easier. So I would buy the leap for January 2026, right? 540 days. That would cost me $6,500. And so my break even would be $125 for NVIDIA. NVIDIA has to hit 125 by expiration. Now, the thing is, you can sell a call against this. This is called a poor man's covered call. So I would sell a covered call. And this would be January 2025. And here they're going to give me. So in terms of premium, they're going to give me $1,500 at the $125 strike price. So this means, let's say by January, if NVIDIA is above 125, they're going to force me to sell the call, right? They're going to force me to sell my leap. That's my insurance against this. And so what's nice is I bought this for 6,500. Let's say it does go up above $125. What'll happen is effectively I would make $1,500 from this, but I purchased it for 6,500. So in reality, I just made $1,500 and I wouldn't lose any money because it would be at the break-even price. So actually, I would pretty much benefit from this if I were to get it called away by January and if it was $125. So Let's say in the worst case, it's not above $125, it's below, right? It doesn't matter what price it is, like $100, $90, whatever it is. Well, now I purchased originally this for 6,500, but you have to remember I got the premium of $1,500. So now my new position for the leap, new leap cost is equal to 6,500 minus the 1,500, which is 5,000. So now I'm only down 5,000. And then this is still the strike at $60. Remember the strike price, $60. So $60 plus these $50, my new break even is 110, 110%. So now I only need NVIDIA, let's say in January, it didn't hit it. It didn't hit 125. Well, I still get to keep this, leap. And now my new break even price is 110. So then the next time I sell the call, I don't have to sell it out at 125. I could sell it out at 110, and then I could collect even more premium, right? So you can play it that way until eventually you get it called away. And that's another way you could kind of leverage your, that's another way that can kind of be leveraged with poor man's covered calls. It's just called poor man covered calls. It's not that you have to be poor to use it that way. It's just another way of kind of leveraging it. Poor man covered calls really good strategy tool depending on the context, right? Once again, not a financial advice, but I think I kind of answered this question in depth about what are my thoughts. Once again, just to recap, NVIDIA kind of a little bit overvalued for me at the moment, so I would stay away. Additionally, for the ETFs that are 2x leveraged, because of the expense ratios, I would also stay away from that for myself. But if it's a matter of if someone really enjoys the stock and has a lot of conviction in it based off of their research, then that's perfect. You know, that's what you should do in terms of your investment. Never kind of base it off of someone else, because when things go wrong, and things will go wrong, when things go down, that's when we need to have confidence in what we have. Because if someone else just tells you, you know, this is a good kind of stock pick and this is what you should do, when it goes down, you don't have that confidence to stay in the position or even buy more, or, you know, kind of think objectively. Versus if you did that research beforehand, then you're fine, right? You can kind of go counter to like people's natural reactions of like panicking, and you can kind of have like a cool objective mind and say, oh no, this is fine. This is just a better price for me, or I can wait it out, or, you know, you can think about it more clearly. So I hope that makes sense. Thank you so much for watching. I appreciate it. Hope you have a great night, and I'll be making some more content very soon.